Welcome to another edition of Inside the Economy. I'm Larry Howes. Thanks for joining me. Consumer spending, new home sales, what the Fed's going to do with rate cuts. It's mostly what we have right now. There's not a lot of excitement going on here at the end of the third quarter. We'll talk about some of the numbers here in just a minute. Basically, what we have are good numbers. We have interest rates have come down a little bit. We've talked about that a lot. We're down basically the cost of money at 4.25. The rest of the bonds are fine. The yield curve looks fine. Oil is cheap. Unemployment is still 4.3, and the initial claims aren't bad. There was a jump in initial claims about 3 weeks ago. Bad data. And the much awaited, what's inflation going to look like? What's the latest report look like? Well, it was zero change. You know, here's where we are. This is all about what's the most important group, economic group on earth. Well, it's the U.S. consumer. Here's the U.S. consumer. This is M2. That's the money supply of bank accounts, of CDs under $100,000, not retirement accounts. This is individual money, savings and loans, all kinds of stuff. And it's about $22 trillion. U.S. consumers not poor. They have a lot of money. They have a lot of sway anywhere on the earth. And as a lot of countries like Germany and Brazil and Argentina and all the rest of them that have been exporting to the U.S. for years are finding out that that group has a lot of sway. Forget the politics. It's how they spend their money. And right now what we have is pretty good jobs. Unemployment rate is good. It's like we kind of recovered after the COVID. Well, we did recover, but recovered well. Recovered at a point where people are spending. They're still spending. More non-store, online, obviously. Less malls, so on and so forth. Well, we know that's happening, and that's continuing. It's not slowing. And the consumer is not accumulating a lot of new debt, a little new debt. And there is a little delinquencies starting to appear, mostly in auto loans, but the whole delinquency number is thrown out of skew because of all the student loans that are delinquent. Personal income is doing fine. The little drop down here was, again, bad data that was corrected. The PCE was up 2.9. Target 2, we're at 2.9. It's not bad. There's no changes. There wasn't any drama, and it wasn't really affected by any changes in the interest rate. There's the inflation. It is down. It is working its way down. It's not ideal, but it's not accelerating either. I don't think there's any forces out there that are going to make it accelerate. Federal Reserve is looking at that very closely. We went from 4.5 to 4.25. That's where we are right now. And the targets, if you believe what the Federal Reserve views as targets, there might be a couple more this year. There might be another quarter point, maybe a half point. Ultimately, the target is 3.25, maybe 3. We're not going to get there this year. That's a safe bet. May not get there in 26. There's no hurry. The markets don't need cheaper money. The markets have lots of money. That's kind of the issue. New homes was one of the reasons, the rationalization that we would lower interest rates to move that market along. Even though the new home sales had been fine, they've been following a track that has been historically pretty consistent, except for COVID. But we had a big month in August when they're making noises about lowering interest rates. And you think there was enthusiasm about having cheaper money or we're going to 3%. Well, no, it really isn't. It's incentives from the new home builders. They're up, 35, 38%. Whether it's buy down on the initial interest rate or second mortgage or whatever it is they work out with the guys in the mortgage business, they can adjust how the interest rates work much better than the Federal Reserve does. And the guys that need to move inventory, pick up the phone. Let's see what we can do. U.S. manufacturing is doing fine. Don't believe the media saying that manufacturing is slowing. It's not. A lot of the new businesses right now, it's new pharmaceuticals. The administration says, oh, you get a tariff unless you're building a pharmacy plant here in the United States. Oh, okay. Well, that's fine. That'll be supply chain and control over it, but it's not where you hire a lot of people. I've been in modern pharmaceutical plants. They're very automated. They're extremely automated. And any of the new ones are going to be, well, there'll be a receptionist and a phone, and the rest is going to be computers and robots. So none of the manufacturing that's going on right now is going to add jobs. They're adding production. They're adding control over our own supply chains. They're keeping the money home, which is fine. They're just not built around hiring new people. Unfortunately, and I will say with a great deal of humility, the markets have still not got my suggestion that they are overvalued. They are overvalued. We're about 20% today. The S&P 500, all of them are over. We're way past earnings. This is wild enthusiasm based upon cheaper money, like that has anything to do with it. It's just the way it is right now, and I can't think of an incident or something that might happen that would bring the equity markets down, but they need to come down. It's not just us, not just residents of the U.S. The foreign holdings in U.S. equities, we're about 20 trillion. The rest of the world has huge amounts of their money here too. This is the market. Everything else is just sort of an afterthought. Bond market. I don't want to get into a technical discussion here about bond spreads, but you hear the term bond spread. The spread means, well, there's risk in the marketplace, so the price goes down on bonds compared to zero risk. So a Treasury is zero risk. So a high-quality corporate like this one, investment grade, is a high-quality corporate. The spread goes up when there's risk in the market. 2008, there was a lot of risk in the market. That's when it spiked. Yields going up. That means the spreads widened. Spreads are shrinking right now, meaning there's very little risk in the market, and people are buying everything that's available. So the bond market is just doing fine. It doesn't care that much about the prospect of lower interest rates. They're just placing money, and they're doing a lot of it. The 10-year yield, it's just not even returned to its average yet. 10 years, they're very expensive. They're very popular. They're very valuable. Even the last several decades, their yield has come down because the value's gone up, and it really not returned to where the average is anymore. And I don't see that happening in the near future. And lowering interest rates doesn't have much of an impact on that. It's just something that's going to continue. Good bond market. And there was a question about China. I know this still makes a fair amount of impact in the media, but China is not the color down there on the bottom, the red, is what China exports to the U.S. It's changed a little bit, not much. It has increased to the rest of the world since COVID because it has to. China has to export. They have to be the low-end manufacturer everywhere they can, or they don't eat. They have to do that. They have cities, millions of people, that sole purpose is to manufacture simple, straightforward things. They have to export that stuff. That's the only way they get any currency coming in. They really haven't had to go through a lesson like Germany has in the last 3 years, which is another total export-driven economy. When your number one customer, and that's the U.S. consumer, slows down, it has an impact. It's had a big impact on Germany and Europe the last couple of years. China probably can't afford to do that. The wages that the vast majority of people in China make, they can't do without them. So China's not going to stop exporting. They'll export to anybody who'll buy their stuff because they have to. Okay, that's enough. Still no drama in the markets. It's okay. There's nothing that is suggesting there's going to be a big correction or a big problem. And we'll know whether the government's going to shut down tomorrow, which will have no impact on the markets. Okay, send questions along to shjwealthadvisors.com. I'm happy to deal with them. And thanks for joining me.